Hello, my name is Philip McGann from Claritude Financial Planning. Thanks for watching the webinar. Today's information is general advice. It's not personal advice. It does not relate to your personal circumstances, even though it may appear it does. Please do not take any action based on the information you hear today without having a discussion with me first up. Today's topic is ESG investing, which is environmental, social and corporate governance investing. It's been a concept that's been around for a long time, but basically at the heart of it, it's about investors screening out certain investments that they don't want to be involved with and looking to not include in a portfolio. So basically things like tobacco manufacturing or coal mining or armaments manufacturing or gambling, those sorts of broad items is what people are trying to get away from. It's termed environmental because it's basically looking at everything from climate change to water pollution to how we look after the environment. Social responsible investing is how companies interact with their workforce, how they adhere to safety at their workplaces, how they pay their staff, how they pay their contractors if they're manufacturing in low-income countries and the like. And the corporate governance side of things revolves around how the board interacts with the company on a personal level, ownership and interaction with other entities they may control themselves, but also how the board interacts when they're dealing internationally in items of corruption and bribery and tax avoidance, those sorts of issues. So it's an all-encompassing thing. ESG investing has been around a long time. It's not a new thing, it's just a more nuanced thing these days. It really flows right back to the 1960s when a famous economist, Milton Friedman, came up with the idea of the purpose of a company is really to maximise shareholder returns. That's it. That was his concept and his idea. There was a lot of blowback on that. And a lot of people said that's not really why companies should solely be in business just to maximise the returns for their shareholders. They need to look at all stakeholders, everyone from their employees to their customers to the government to the community to the environment that they operate in. And if they do that, the returns will flow for shareholders as well. So the idea behind ESG investing has been around a long while. It used to be called socially responsible investing or ethical investing, but it's been more nuanced over the last few years. The last 10 years or so, there's been, in the area, in the investment community, there's been an adherence to trying to get around the concept and actually making your products look a little bit better than they are, particularly on the environmental side. The term greenwashing has been coined to describe fund managers and companies that are promoting themselves as environmentally aware, but they're not really. So things need to be tightened up, and they are actually accelerating a lot at the moment. The European Union has just come out with new rules that are in force at the present time that will make fund managers who operate in the European Union adhere to more legislation to work through why they invest in certain companies, how they've sort of come up with the screening techniques they have, and why they have assigned certain attributes to companies and why they've invested in them, to actually allow investors who invest in their funds to have confidence that things are a lot tighter than they were. The European Union is a big market, so that legislation will have ramifications around the world, into North America, into Asia, into Australia also. The ESG market is a big market. In the European Union last year, of all the money that flowed into active management or into fund managers' investments, 84% of it was in the ESG space. In the Australian context, it was only about 8%. Now, the discrepancy there flows through to how our market is very concentrated. The top 10 stocks in Australia are 4 banks, 3 major mining companies. Not exactly poster childs for ESG investing. So it's very difficult for an Australian investor, if you're looking to actually get exposure in this space, to do well and to actually get the exposure that you're looking for if you solely concentrate on the local market. You tend to have to drift to the smaller company sector looking for renewable energy and biochemical and medical device companies and the like. So what you tend to have to do is to go offshore. Now, how can you do that? Well, you can try to invest directly yourself, which is pretty difficult, or you can actually do it via exchange-traded funds that are listed on the local market, the ASX. You can get into separately managed accounts where you can actually instruct the manager to exclude certain individual companies that you're not comfortable with. And there is a lot of active managed funds which tend to be unlisted in this space as well. So there's a lot of choice, but you need some assistance to get there to help you with that. And that's what I can do for you. I can actually screen out a lot of these fund managers, and I can actually put together a portfolio that will help people to get to that result they're trying to achieve in this space. So if I can assist in that area, that's what I will do. You can contact me on 0491 686 236 or contact me via my website claritudefp.com.au. Basically what we're trying to do in this space, if you want to make a difference in the world, don't just leave it to the consumption and the recycling that you're already doing. Extend that out to the investing, whether it's superannuation money or non-super money. It's an opportunity for you to make a difference in your investing world as you do in your consumption world as well. Philip McGann, Claritude Financial Planning. Talk with you soon.